Hey, all you clever refinancers out there, in a recent video, we talked about why you don't always have to make mortgage payments when you're refinancing. And in today's Red Friday video, we're going to dive a bit deeper into why that is and how you can actually defer these two mortgage payments. Hey everybody, it's Eric with Low VA Rates. Loving today because it's Friday. The whole office is full of red because we love you guys. We love our veterans. We support what you're doing and your service. Thank you for all you do. Speaking of red, hit that red subscribe now button down to your right so that you can be one of the first to see these videos when they come out each and every week. Now, to start, before we dive right in, we need to talk about the word defer. Okay, here it is. We need to talk about this word right now. Out in the real world, people often talk about skipping mortgage payments. That is a big no-no. Okay, you might have even seen lenders use the word skip in their marketing or their mailers or on the phone instead of the word defer. Okay, here at Low VA Rates, we never ever intend or want to mislead anyone, which is why we never refer to skipping payments. I'm going to tell you here in just a few seconds why you're not actually skipping anything. The truth is, you don't skip them. Instead, they're included as part of your new loan, and you'll still end up making those two deferred, skipped, whatever. We're not calling them skipped, but you'll still end up making them over the life of your loan. So you can't refer to them as skipping. Now that our terminology has been sorted out, let's talk about how deferring these two mortgage payments actually works. Basically, you're able to defer each month for different reasons. You can defer the first month because that payment is included as part of the payoff amount for your old loan. I know that can be confusing. In order for your refinance to close on time, the payoff, which is the amount needed to pay off your old loan, needs to stay consistent, which is why your lender usually tells you to not make your current mortgage payment once you get your loan in processing. For example, if you're scheduled to close a loan in June, then your June payment that you would normally make if you weren't refinancing will be included in the new loan amount that's used to pay off your previous loan. Now, you can defer the second month because of how VA loans and mortgages in general are paid. When you close a loan, the first payment is never due until the first of the month, a full 30 days after the closing date. So, using our example, if you're scheduled to close in June, on the 12th, let's just say, you're going to close June 12th. I'm just going to put this up here in case it helps to follow around. You're scheduled to close June 12th. Let's say the next first of the month, that's a full 30 days away, would be August 1st, okay? Because July 1st is only, 28, 29 days away, depending on how many months there are in June. We need a full 30 days into the future. The reason this full 30-day delay is that mortgage interest is only paid after it has been accumulated or accrued. We use the word accrued interest many times. It's an accounting term. Another way to put it is accumulate. I hope I spelled that right. Accumulate. Looks right. So there needs to be sufficient time for the interest to accumulate before the lender can ask you to pay it. Okay, now I'm going to pause you here for a second because this is so different than it is for rent. Think about if you're a renter right now. When you first moved into that property, your landlord, not only did he want a deposit up front, right, a safety deposit, first month's rent, but then if you moved in on, June 12th, you paid rent on June 12th. Maybe you even paid it on the 1st, but you pay it right away. You're always paying your rent up front before you live in the house. On a mortgage, you're paying it after you've accumulated a full 30 days. So if you want to defer two full payments, the best way to do this is to schedule your loan closing for the beginning of the month. Scheduling it for the end of the month may mean you need to make your current mortgage payment in order to avoid late fees. It can be very stressful. Now listen, we do close people at the end of a month and they still can defer two payments. We're experts at setting it up this way. But if you have the power, which you do as the veteran, do all you can to try to close your loan earlier in the month. Even though mortgages are usually due the first of the month, most lenders will give you a grace period. So after this grace period, usually sometime between the 10th and the 15th of the month, you're going to pay a marginal, usually pretty small late fee. In order to avoid that late fee, you need to make your mortgage payment before that date. So making your current payment would mean you'd no longer be deferring that first month as part of the payoff. In addition, scheduling a closing for the end of the month could cause further problems if the closing gets delayed or has to be scheduled to the next month. Is it actually worth it to delay your mortgage payments or defer them for 2 months? As with everything we teach you guys, there are pros and there's cons. Let's talk about the pros, okay? What are the pros or the benefits of deferring 2 mortgage payments? Well, it's going to improve your cash flow. Let's just, again, I like to use simple math around here. Let's say your mortgage payment's $1,500 a month. If you defer 2 payments, that's $3,000 that you're going to keep in your pocket. You could use that money for other things like paying off your credit cards, unexpected medical bills. Maybe you could go on a vacation. You know, you might just put it in the bank and add it to your savings plan to pay off future debts or to save for a rainy day. Okay, so the main pro is more money today in your pocket. Personally, we would recommend setting it aside to make one larger lump sum payment once your new loan comes due in a couple of months if you don't have anything else to use the money for. Okay? Put it right back into your mortgage. Here are some cons or some risks maybe that you could come across by deferring payments. The unpaid interest being added into your payoff and into your new loan makes your balance go up. So you're going to pay more interest over time the more you borrow. You also have to be careful to avoid late fees or being so late the whole closing gets botched up, you haven't made your payment, and then you become 30 days past due. That's going to hurt your credit score. These are the risks, right? The timing and additional interest being added into your loan. Personally, I just refinanced some rental properties. I defer payments. That's what I do. Just because I do it doesn't necessarily mean you need to, but I always practice what I preach. I believe when you're borrowing money down in the low 2s or 3s, which is where we are today, there are so many better things you could do by pocketing that $3,000 or whatever your 2 mortgage payments are. There's way better things you can be doing that you're likely spending more than 2, 3, 4%. Now, if you have no debt, no unexpected bills, and you don't have something better to do with that money, then by all means, throw it right back into your mortgage payment when it comes due a month or 2 after closing. Thanks for watching. If you have any other questions, we are just a phone call away, a text away. You can live chat with us. Please reach out. We'd love to help you when the time is right. We'll see you next Friday. Hopefully you're wearing red just like I will be. Thanks for watching.